So there's going to be a lot of things that I think are going to keep him from acting the way he should act until they don't have a choice, until all of a sudden they're the deer in headlights look, and it's like, oh my God, the whole financial system is about to crater. That's what I think is coming. I'm not sure.
So I'm glad that you touched on the consumer, because I actually wanted to ask you a question on the consumer before we head over to the bust. So how much longer can the consumer really remain intact? I mean, they've been beaten up pretty hard now for several years, like you just said. Elevated prices on everything, savings are depleting. Here's a couple of stats. It's been reported that 1/3 of Americans making more than $150,000 are living paycheck to paycheck. That's astounding.
Yep.
It's been reported that 56% of Americans can't even come up with $1,000 to cover an emergency expense. Credit card balances are rising very quickly. Delinquencies are rising. Other types of consumer loans, buy now, pay later, everything's just exploding. So, now they're going to experience this melt up. So there's going to be a rise in costs. I mean, these input costs are going to go up, so there's got to be a rise in cost. How much longer can the consumer really remain intact?
Yeah, and that those credit card balances are going up, and people are using their credit cards more for groceries today than ever before. I mean, that's what I mean by have and have not. You've got a chunk of the economy that's in trouble. I think Powell's aware of that to some extent. I don't think they're, I give him credit. He really is of the opinion, if we don't get this inflation down, that's a bigger pain for the ones that are suffering. Yes, it's hard. Yes, you guys take the brunt of it, but it's going to be much worse if we let inflation get back out of here. So he's sincere in what he's doing. I don't get why people treat him like he's evil. But on the other hand, yes, we've got an economy, and I even say, going back the pandemic, one thing the pandemic did that we haven't had before is it created fragility in the system. So yes, we came out of 2020 and had this statistical rebound that you were marveled at, because if in April of 2020, if somebody said we'd a year later be looking like things are okay and we got through it fine, you never would have believed that. I mean, we were locked down. People, you basically told small business they couldn't open their doors. You could only go to Target and Walmart. I mean, all of those things add to fragility. And whatever I say about the U.S., it's worse over in Europe. I mean, look at what happened to their energy prices. Look what happened. I don't know where. It's amazing. This economy has been, both here and abroad, has been as resilient as it has been. You got hit on all the, your necessities. You also got hit on housing. If you wanted to buy a house, forget it. If you hadn't bought already. So there's so many things that I think add to this cycle being more fragile than a normal cycle, which means when things go south, you're going to see a lot of things come out that, because of that fragility. So
let's go there. Let's go to the bust. In your analysis, when things go south, what ends up ultimately causing the bust? What pricks the bubble here? Is it the consumer that's under all this heavy pressure? What is the trigger for the bust?
Yeah, it may or may not be triggered here. A big part of the bust, it's a big downturn. I'm not sure whether the ultimate economic downturn will be bigger than 2008-9, but I think the financial part of it, the financial crisis part of the bust, which is why it's a bust, will be bigger than 2008-9. So I say that in the fall of 2008, when the commercial paper market froze, and we heard that GE credit was hours away from, default, and GE was basically about to go under, the stock was down there near zero anyway, $3 or $4, I think, maybe lower. We came very close because they were so dependent. G credit was so dependent on commercial paper market. It was frozen shut. If the government and the Fed had not acted very quickly to open that up, we would have seen what a bust looks like then. We avoided a bust because of those things. So the difference between 2008-9 and today, in my opinion, is this time we go over the cliff. That time, as bad as it was, we avoided going over the cliff.
Barely. So you don't think the Fed's going to step in until it's too late?
Right. Yeah. I think partly because of 2008-9. If you listen to Jay Powell, it's, we're never going to do QE again like that. We're never going to, he's got a lot of things that are in the back of his head. One is, I don't want to be accused of that Fed put. I don't want to be the one that's just bailing out the stock market. I don't want to be the one that pours money in and then we have to deal with the inflation like we did in 2022. I don't want to be the one that went the wrong way here and created inflation. We've worked so hard to get it down. So there's going to be a lot of things that I think are going to keep him from acting the way he should act until they don't have a choice, until all of a sudden they're the deer in headlights look. And it's like, oh my God, the whole financial system is about to crater. That's what I think is coming. I'm not sure what the catalyst will be. The reason I went back to 2008-9 is 2008-9, our banks really were the trigger. I think the trigger could come from Europe this time. I mean, it doesn't have to come from here. So they're in worse shape than we are. And so their banks, our banks got religion. We're forced to get religion after 2008-9. So our banks are better capitalized. Our big banks are better capitalized. Their banks are in much worse shape. As are Canada and Australia, and certainly Asia's got their big set of problems, both Japan and China, for different reasons. So I'm not sure what the catalyst will be ultimately. Could be a zig when they should have zagged from the Fed. It could be just the accumulation of everything. Separating out the economy from the market, because I also the terms get mixed and matched. So I talk about a bust coming after the melt up, but the bust doesn't mean stock market bust. I say it's a bust and bear, or a bear and bust. So there's a bear market to accompany the bust, but the bust refers to the economy and the financial system, if that makes sense. Whereas the bear market refers to the actual stock market. But they're obviously going to happen somewhat coincidentally, and I'm calling for an 80% bear market.
So are you essentially saying that we're going to have significant deflation taking place?
Yeah, it will be short-lived. This bust probably will be over by the middle of 2025. Certainly the stock market will bottom before the bust is over. So it may be all the way through 25 for the bust. I'm not sure. But the stock market will have bottomed probably early next year sometime, first half of next year sometime. So, I think deflation is likely. We're almost at 2% now, and we haven't even had the downturn. So, to me, I don't know how big it will be. It could be 3 or 4 or 5%. But my guess is it's easier to talk about the response than it is to talk about exactly how it plays out, or how, what triggers it, what have you. The response is probably the easiest thing I can do in forecasting, and that is ultimately, I think you're going to see a global response from the central banks that will be many-fold bigger than 2020, 21. So I'm saying the Fed balance sheet, which got to $9 trillion, I think in the bust will grow to 30 trillion plus. So that's we're below 8 trillion now. Let's say they turn, it's going to be something over 20 trillion, unheard of. And I have to stop and say to people, I am not endorsing this. This isn't. I'm telling you what's going to happen, not what I think should happen, or what's good. This is just how I think human response to a bust is very predictable. Our governments And our central banks have no choice when they're staring at a free-falling financial system globally, and I mean free-falling. There's only one tool they have that can move quickly, and that is money. They
So
will just
how deep is the free fall for the S&P, the Nasdaq, the Dow? How deep is it
I think it's an 80% bear market peak to trough. So if we peak at
for all the indexes?
yeah, I mean, one will differ from another by a few percent, but I think it's basically a broad-based 80% decline. Um, and we had a 90% decline in 29 to 32. So this is an 80% decline. And it will, if the S&P, if I'm right about 7,000, you're talking, and again, it's not going to be precise, I'm not going to be right precisely, but that would be 1,400. I mean, that's unheard of. If we go from 23,000 down 80% from the Nasdaq, you can figure it out. It's just these are numbers that are mind-boggling, and I'm not saying it's going to go there in a month. I think it will be at least a two-legged or two-step process. You'll go down 40 or 50%, 50% retracement back up because the Fed put in their first tranche of money or something, or central banks did. And then you get up to that point. Next thing you know, you're down another leg that takes you all the way down, or maybe it's three legs down. I don't know.
Yeah, similar to the Great Depression moves.
Yeah, and this stuff doesn't go in a straight line, and people say, well, the Fed's not going to let that happen. Don't you think the Fed will? I go, there's a problem. This is when you talk that magnitude of the problem. I don't think anybody gets it. I don't think any central banker has any clue that this is what's coming.
Do you see this playing out in the broad economy as well? Real estate, automobiles. I mean, just the things that you are seeing. You're shaking your head. Yes.
Yes. You're gonna have again. I think I don't remember what the GDP number was for 2008-9. You're going to have something like that, maybe more or less, I don't know. But you're going to have a real economy hit. Retail is going to be down, auto sales are going to be down, housing. I say, and again, it's just a guesstimate on my part, but I say real estate will probably fall at least 30% from its peak. So the peak really happened, a year ago, maybe? And, in some places it's probably gone higher, in some places it's down. But ultimately, from that peak, 30% probably only gets you back to pre-pandemic.
Mm-hmm.
So it could be more than that. I don't know.
But it's going to feel awful.
Yeah,
if that's what happens.
Yeah. And particularly for those that bought in the last 5 years or last 4 years and paid those prices, and the last 2 or 3 years, I mean, they're going to be down a lot. For those that have been just, had an equity in their house go a lot higher, they'll lose some of that. But and for those that leverage themselves up with a second, mortgage or whatever, they're going to hurt. But
Are there any winners here? Is there a rotation to safety that some are going to come out relatively unscathed?
Well, I say the three assets basically that I think will hold up in the bust and in the bear market are U.S. Treasuries, everything from T-bills to the long bond, because rates will drop from 2.5%, 3% down to zero, on the 10-year, and go to zero and below for those shorter rates. So any Treasury, because you have that government guarantee, will be probably the one thing that will appreciate in the bust. The dollar, once it goes to 80, I think you could have a total retracement and see it back above 120, because of a flight to safety. As much as people want to talk about the dollar losing its luster and all the problems ahead, I don't dispute that. I think they're premature. I think they're coming in the next 10 years, next 5 years. But during the bust, the U.S. will still be the place that people will look to as the safest place out there. So both in terms of buying treasuries and buying the dollar itself. and both support the dollar. So I think you're going to have the dollar and treasuries being the two places where you will probably have appreciation, and then cash. And I say, as long as you're in FDIC insured accounts below the threshold, below 250 per institution, I am not worried about the FDIC this cycle. The government will provide whatever is necessary to meet their liabilities, and they have the printing press to do it. So, that 20 trillion increase in money supply is going to be matched by probably something similar in debt. So that debt's going to be put in all kinds of places. They'll probably be bailing out pension funds. They'll be bailing out, the FDIC. They'll be bailing out banks. There's going to be money coming out of it. They're probably going to do universal income or something like that, or direct to the kind of what we saw in 2020, except bigger.
I was going to ask you about that. So yeah,
I mean, it's sad. It's all ultimately doesn't end well, but it's
no. That's terrifyingly sad for so many. So you mentioned earlier gold going up to 3,000. You see that retracing back to the 2,000 level, or do you see it going even below that?
Yeah, I think for gold it probably doesn't fall much below that, and it may not even get back here. I mean, it could stop at 23 or 400. I don't know, because as you print that money, it may start turning up before everything else. Silver, on the other hand, is a different animal. Obviously, it's poor man's gold, but it's also an economic product, and EV.
So it may. You see, so it may rising to 60, but maybe dropping even below 20 or 15 or
right.
Yeah.
Yep. And I don't know. It could come back to here, or it might drop below here. I don't know, or it might not get back here. But it definitely is going to be more volatile than gold.
And then copper, you mentioned $1. Was that just a number you threw out, or is that the number you're?
Yeah, I would say that's a legitimate. I haven't put out an official target, but I'd say that's a very possible scenario.
Wow. So not a lot of building going on, not a lot of growth, expansion. In fact, very negative globally to arrive at that. And oil, I don't think you had mentioned a number for oil. Where do you see oil in the bust?
Yeah, I didn't want to get ahead because we haven't talked about the bust, but I do think in the bust, as I said, I think it can get to 60 in the next 6 months, let's say 6 or 8 months, or less, next few months. In the bust, I think it can go to 30.
So it's not going to go quite negative like it did during the pandemic.
Right. Yeah, I don't think we're going to see that 2-day job where it goes to whatever was minus 10 or 20. Or,
right.
That was and by the way, when oil was years ago, but when oil was, I think it was $80, 70, 78 or $80, before the pandemic, a year before the pandemic or whatever, I called for oil down to 20. I may have even called it down to 10. I can't remember. So when it went down through 10 and went to negatives, there was nobody else looking for anything like that. And it's like, but I didn't see this coming.
Yeah, right. So what do you call it? Oh, go ahead.
I just to finish it out, let's say oil gets down to 30. That huge, and it's going to be 20 trillion here, let's say, and proportionally similar money coming out of every central bank in the world, including People's Bank of China and Bank of Japan, Bank of Canada, et cetera, ECB. That money is going to trigger a huge inflation cycle that will blow through the early 80s cycle. And I'm saying we'll probably see 25% inflation by the end of the decade. I think oil can get to $500 a barrel in that scenario. So,
wow. So I do want to hear more. I want to hear more about that, the post Federal Reserve printing and intervention. But before we get there, I got another question or two on the bust, and that is the first one being, what do you see for unemployment? Do you see, as the markets are busting and the economy is tanking, are you seeing massive spiking unemployment levels and millions of people being put out of work and onto government assistance?
Yeah, I mean, I'm assuming it's just a very lagged effect that once we'll see a normal response from businesses it may not get up to the levels we saw in 2020, or I can't remember where it got to in 2008-9, but I think double digits is a possibility. I'm not looking for 20% or anything like that, but I think because I don't think the cycle is going to be that long, this down cycle. So, but I think it possibly could get up there. We're in a strange job situation where it's been hard to find employees. So I just don't know, and how we're counting them, et cetera. I will say, as a kind of as an aside, going back to the very short term, last Friday's jobs numbers and how the market responds to them. I mean, most our job stuff jobs are lagging anyway, and nobody's breaking them down into full-time, part-time, or not very many people are. Most of the gains are in part-time work. It's more of a negative commentary on the economy. People are having to find extra jobs to make ends meet.
So I read a study that a gentleman did, and his name is eluding me right now, but basically for every 1 point move in unemployment, it equaled 700,000 people put out of work. So if we go from the current 3.7% to double digits, let's just say, we have a move of 6 to 7 points, we're talking, 5 million people being put out of work. At the same time, where we are now, the U.S. is running 3 to 4 trillion in annual deficits. I know they say it's less, but last year I think we were pushing 3, and we're escalating already in this early part here. So during a time, though, that there's been no major war that we've been involved in or a recession. So we're running like literally wartime deficits or recession time deficits when neither of those things are taking place. Now you're going to throw, not you, but now, this bust is going to throw 5 million people plus out of work and onto the government dole, plus the slowdown, plus the need to help with pensions, taxes for states and cities and whatnot, and everything else that you throw in there. How does all of this get funded? And I guess I was going to ask you if it's inflationary. That's what's in my notes, but clearly that's why you're calling for a 25% inflation rate.
Oh, it's like I said, I'm a monetarist. There's no doubt in my mind it will be a lag, but there's no doubt in my mind, the second half of this decade, we're talking about inflation going from negative to, negative during the bust to probably 3, 4, 5% the first year out of the bust, to double digits by, 2.5 years out of the bust, to by the end of the decade, 20% and roaring higher. And, I'm one of the few that's still around that was investing, was in this business in the early 80s and watched inflation go. And, I don't know, people pick it out of the books and, they talk about 14%. I can distinctly remember inflation being 21% or 20% and T-bills being 21%. And this is going to blow through that. I mean, the numbers we're talking about here, I don't see any way they can't. And, frankly, and how do they fund everything? Well, initially they fund it. That's what, that printing press. They're going to be stupid enough, because we're at $1 trillion in debt servicing costs now. You add to all of this, you multiply your debt. You bring another 20 trillion in debt onto the government dole, and rates start going up to 5 and 7 and 8, 10, 12. Ultimately, I think the long bond or the 10-year could approach 20%. It peaked out at 15%, I think, or 15.5% in the early 80s. I think this time we'll exceed that, whether it's 18% or 20% or 70%, I don't know. There's no way you can solve that equation. We can't fund our debt. We can't service our debt at 5%.
Well, that's a whole nother show that I need to bring you on to discuss that whole thing. Is there anything the Fed, Treasury, government can do to avoid the bust? Is it baked into the cake and unavoidable, or can it be averted?
Yeah, well, obviously it's a forecast, and I can be wrong. As I put it all together, this is what I think the outcome is. could I be wrong about money's impact and how they respond, or how successful they are in kind of getting this through this without breaking? It's possible. I just, what I see out there, my bigger picture view is that we're at the end of a super cycle, and I define super cycle as the long cycle between two depressions, the 1930s being the last depression, the 2030s being the next depression. And I think what happens is every cycle, you build up more excesses. And we're now at the point in the last stages of this where the excesses have gone so beyond, and the response to those excesses to pull us out of those downturns requires so much more. And then you've got leads and lags that they don't really understand, and they always go too far, that it gets unmanageable. And then you get a really big break, and a response to a really big break, and then I think you get a collapse. 2030s, I think, becomes the end of the Ponzi scheme.
Yeah, that's a very dire picture, and it'll be, if it does play out the way your analysis is leading you to envision, it's going to be very sad for so many people.
Frank, and again, this is global, so I'm not saying the U.S. is, going to go down and somebody else is emerging as a leader. That may happen, but this is a global issue. China's so-called miracle of the last 20 years was all fueled by debt. I mean, it was basically that they did more debt than anybody else. Japan's abilities to do, I still don't quite understand how they've managed to contain inflation, but there are all kinds of signs that that's going to start breaking out. If that does, they're in trouble because of the way they've managed things. So they could be a big part of the bust. They're just, I just think, laws of gravity do still apply, and we're operating like there's always, MMT scares the hell out of me. We're seeing kind of MMT happen without calling it MMT, but there's no such thing. I mean, you can't, printing money leads to inflation at some point. You can't have your cake and eat it too. You can feel like it for a little while, but then it goes the other way, and you're paying a huge price.
Mm-hmm. Yeah. Math, reversion to the mean. These are all laws. You can't avoid it. It's just a matter of time. Yeah.
Yep.
Well, before we wrap up here, and I ask David the final question, I want to point everyone over to our Substack, which is metalsandminers.substack.com. We post a lot of free content on the consumer, economy, markets, and individual metals and miners each and every week. The content keeps what is important in these economic areas top of mind for you. We organize it all in one digital destination that you can come back and refer to at any time. So go subscribe for free and get access to all of that. And if you want more, there is also premium content that you can access as well. Some of the premium content includes our nugget notes from each interview. That's our Cliff Notes summary of each guest interview. Access to some premium interview content with guests that's not in the free videos, and it's only found on our Substack. And there's other benefits for premium members. If you've enjoyed the conversation with David as much as I have, will you please let him know by hitting the like button and clicking on that red subscribe button and the bell icon and leaving a comment below the video. All right, David, let's wrap up the discussion here. I've got a two-part final question for you. What is something that you worry about or keeps you up at night these days? And the second part is, what haven't we spoken about today that you want the viewers to know or be aware of for this year, 2024?
Yeah, that's hard because we've just laid out what I'm worried about. I mean, I'm not a black swan person. I don't, obviously there are plenty of things out there to worry about, like Taiwan. I mean, if that ever happened, given our dependence on Taiwan for semiconductors and how important semiconductors are to everything we do now, I can't imagine what comes there. Our leadership today seems ill-equipped to deal with all the risks that are out in the world today. That keeps me up. But I've got enough on my plate in terms of my scenario to keep me up that I don't think about those things too much. And then what was the second question?
Yeah, just is there anything that we didn't discuss that you would like the viewers to know about 2024, about this year, something that you're thinking about?
Yeah, the only thing I would say, because this is it can seem very schizophrenic, big run up and then a big run down, etc. And again, some people think it's my personality or something. It's not. It's where we are in the super cycle. So understand that. And secondly, for people, understand psychology enough, the importance of psychology on the markets to recognize that you're probably going to get pulled in at the top. The odds are the vast majority of investors, before this thing is over, will be convinced that there's a reason to be bullish at the top. And if you can know that ahead of time and guard against it, you're going to avoid a lot of pain, because I can't give advice or tell people how to play this last run, but I can tell you that if I'm right, what comes on the other side of this mountain, you will not want to be a buy and holder. You will not want to be somebody that says, "Hey, I'm in an index. I'm just going to ride it," because in the long term, we always go higher. I think that's going to be disproven in the next 20 years. I actually think the highs this year in the indexes, particularly in the S&P, may stand for decades, not a decade, but decades.
Wow. Yeah, well, thank you so much for being so generous with your time and your analysis and your ideas, David, and for coming on to the Metals and Miners podcast. It's been really good to spend this time with you. I've really enjoyed hearing about your thesis in depth and learning more about it. Would you please go ahead and tell the viewers where they can learn more about your work, how they can connect with you, and where you can be found on social media?
Sure. I'm on Twitter pretty much every day. I mostly reply. Once in a while, I'll send out an initiated tweet, but in the last couple of years, mostly it's replies, and I do a lot of replying to questions and things. So you can find me on there every day. I use the replies basically as a way to educate, a way to get my views out there, but also to educate the retail investor. I will reply to most people. Once in a while, I get a troll who just wants to fight, and I'll block them. But for most questions, I'm a contrarian, so I expect people to disagree with me. That's okay. And then I have a quarterly letter that I put out by subscription. And if anybody has an interest in that, there obviously is subscription cost. If people want details on that, they can direct message me on Twitter. I don't have a website, so there's no website you can find. But those are the two ways really that I communicate to investors.
Wonderful. Again, it's been a wonderful time spending with you. Thank you so much for your generosity, and I look forward to having you back on.
Yeah, thanks, Gary. It's been my pleasure.